Hello, it's Brian Shannon from AlphaTrends.net. Today is Thursday, the 6th of November, 2008, and we had a continuation of the recent selling that we've seen here. We'll start out today by looking at the NASDAQ 100, symbol QQQQ. A lot of people have been asking me lately, why do I follow the Qs most closely as compared to maybe the SPY or the Dow Jones or something. The NASDAQ is where I trade most of my stocks, and in the NASDAQ 100, the Qs here represent the 100 largest non-financial stocks, and that's basically the universe that I trade most aggressively. The NASDAQ, the Qs themselves trade a tremendous amount of volume, and there's also the ability to get leverage with the QLD and inverse leverage with the QID, which obviously had a very nice day today. When I point out that I have a negative bias towards the market, you should assume that it means that I'm looking at QID. I'm not going to mention QID and SDS and a lot of these other inverse funds each day because it simply takes too long. But if I'm bearish on the Qs, it means that I'm looking at the QID. Let's take a look at the Qs here, because what we see obviously is a continuation of the weakness we saw yesterday. Yesterday we saw this little trend line break, and that also took out the 5-day moving average, and then it continued weak and got below that 3250 level that looked like it might be acting as support. If you recall, also this level was an important area because it was basically well, we got to go back to the hourly time frame. A 38.2% retracement of the move from these highs up in mid-September down to the recent lows late October. So that 38.2% retracement level did act as resistance. I had suggested that we wanted to look at it as an area where the sellers might emerge and where the buyers might basically go on strike. That inflection point, was an important level to hold to be looking at. And now if we look at a 30-minute time frame here, we can see that just taking the low there from October 24th up to, and that's not what I meant to do, Fibonacci here, that low up to just the high from the other day, we can see that a 2/3 retracement right here of that move. So basically what we're saying is from here to here, if we take 2/3 of that, or 61.8% according to the Fibonacci numbers, we've retraced that. So if we break below here, it's considered that this rally attempt has been broken, and obviously we remain in a primary downtrend, so all rallies should be treated suspiciously. We've got a declining 50-day moving average, we've got a declining 200-day moving average, we remain in a bear market, and the only thing that's going to change that, well, let me say a few things that aren't going to change that. Earnings for some big company like Cisco or Intel or Google, things that aren't going to change it include legislation from our government, a change in administration as far as who the president is. Those things don't change this flow of funds when it takes a lot more energy to reverse a trend than it does to sustain it. And that's what we're seeing here, is that we've seen some phenomenal rallies in here, and they're great for trading purposes, but true to the typical bear market rally, you need to look at them as guilty till proven innocent, because obviously if you're still holding in here long, there's something seriously wrong with that outlook as the market continues to get hit with these large percentage moves like today of 4.5%. We've got a pattern in here of lower highs and lower lows. There is no reason to fight where the big money is flowing, and it's flowing out of stocks. It continues to flow out. We've got a declining 5-day moving average. We're not going to get back to a recovery this week, tomorrow being Friday, so it's not safe to buy, I don't think. A lot of people are looking at it, and I thought maybe we're going to see the beginning of a multi-month rally. I'm going to go back to that again because there's still some confusion amongst people who've emailed me, and I said there's the possibility that we could rally, but it doesn't mean that you can just go in and buy and hold. Risk management is job number one, and as soon as we see these critical levels being broken and lower highs and lower lows, you've got to put that way to the back of your mind. There is no sense holding on to any bullish hope when prices are declining. Forget about what volume is doing, forget about all that, because the only thing that pays is price. Now, this may sound contradictory because today on the 1-minute time frame we had seen a short-term rally right here back to that daily VWAP, and I had posted on the blog that it looked like it's battling with VWAP here, but I wasn't convinced that it could turn around and push past the short-term resistance at 3120 simply because there was a lack of volume in there. Volume is an important tool. It allows us to measure to gauge the intensity of the participation. And while we had what looked like maybe was a little bit of a recovery here, I was skeptical that it could last simply because there wasn't big volume in here. When we had seen this rally right in here a week and a half ago unfold, if you remember back to that video, I was getting long into that, even at these levels here, because we had seen a huge increase in volume. We're not seeing that. We're seeing no evidence that the buyers are stepping up once again. In fact, a little bit heavier volume. The only thing that cures a bear market is time. It takes time to heal the psychology and the price damage done in here. And again, if they don't scare you out, they'll typically wear you out. As I defined in my book, the definition of a bear market in my mind is a declining 200-day moving average, and this is clearly still declining. We're going to need to see that flatten out, and that's going to take quite some time before it can flatten out and turn higher again. There will be certain sectors that move not in relation to what the overall market is doing, and you can trade those to the long side. Someone had suggested airlines, and for instance United Air. United Air looks like it's doing battle with some resistance here, but not reason to get involved yet. We've still got a declining 200-day moving average, and in UA on the weekly time frame, you can see here that it's building a higher low here, and we've got some resistance, but it's not convincing yet. If it can rally, where is it likely to go? Perhaps up to here. But let's go back to the NASDAQ, because that's what we were talking about. So we've got the potential now. We will have to look at, as I was saying on the 30-minute time frame, we've got the potential that maybe we're going to see a quieter day tomorrow because we've retraced 61.8%, and we're also back to this level here that had been important as far as resistance, and where that rally that I was talking about here materialized from, basically at 30.25 to 30.5 level. Breaking below about 30.25 and holding below it for more than, let's say, 20-30 minutes or so, we might see new lows in this NASDAQ. We remain in a bear market. Risk management is job number one, etc., etc. Gold was down again here today, down 58 cents on the GLD. My opinion has not changed there. It's pretty choppy in here. We seem to keep gapping. We had a big gap higher today, which completely failed, and the gold market still looks quite vulnerable to me. Looks like it should probably continue lower. Oil, again, this is why if they don't scare you out, they're going to wear you out. There's no sign of a bottom in here. OPEC can't move this market, neither can a reduction in the output from one country in OPEC. So you've got to just look at price, and you can make a lot of arguments that make sense as far as why oil should be doing this or some other market ought to be doing that. But if you look at these markets and you see these price movements fail, like we saw here yesterday below that 56.25, it said basically that the sellers were still there. There's no reason to be involved on the long side. The financials were down again. Obviously, they remain the root of all the weakness here. We've seen recently that this 17 to 18 has been an important level of resistance. Drill down to a 30-minute time frame, we had seen resistance right here at these peaks, and now we're within spitting distance basically of hitting these lows here, and coming down to these lows and breaking below it could lead to further deterioration and even lower lows in here. Don't think that it can't happen just because it's down X amount or percentage or whatever. The path of least resistance remains lower. Let's take a look at the Fibonacci off the 28th lows here. You can see we've gone more than 2/3 beyond that level. So this rally attempt can now officially, according to Fibonacci, be called a failure. But obviously we had seen evidence of that prior to it hitting this level, with the lower highs, lower lows, back below the declining 5-day moving average, etc. The Russell 2000 was down $2 or 3.8% today. On the daily time frame, you can see here that it found that resistance up up in here. Looking at a 30. Let's look at the 60-minute time frame. Let me change this scaling because this that's going to disappear off there in a couple days. That big wild movement back there from the 19th or so of September. But anyways, we've seen resistance up in this area, and you know, maybe an inverted head and shoulders pattern. It's good to be aware of these patterns. I've been pointing out the possibility of one forming in the SPY and the Qs and that sort of thing, but they got destroyed, and now this one has the possibility to form a inverted head and shoulders pattern. But look at this, you know, what's the beginning of this right shoulder right now, this on this 10-minute time frame. Here we're at 49.60 or so. Back to the hourly time frame, here's where we are. We're still clearly making lower highs and lower lows. So, you know, maybe getting back above here leads to a test of the 5-day moving average, but that 5-day moving average is declining, and I would expect that rally attempt to fail until we've, you know, taken some more time to settle in. And this market remains, again, extremely dangerous. The SPY, spiders, S&P 500 were down $5.38 or 5.59%. Obviously, we had seen the failure of the market to hold on to the break past that 99.25. Let's look at that on the 10-minute time frame. So this market broke past that 99.25 level, and then it failed to hold there. So this is where we'd seen the lower high and the break of support here. It tested that 5-day moving average and failed yesterday. That 5-day moving average was flattening out, and today it was just straight liquidation pretty much all day long here as the market came down very close to its lows is where it closed. And this market tried to rally midday as well, but couldn't get above that declining daily VWAP. When we look at the 30-minute time frame, or let's take a look at the 30-minute time frame in here. Let's take a look at the Fibonacci off of this low, the recent low up to the recent high. You can see we're right at that 2/3 retracement. We're also at this prior level of resistance. I think a failure to basically hold on a closing basis tomorrow of about 90.25 or so. I think if it can't hold that, then you've got to be really concerned and think that possibly the next shoe may drop and bring us back down for at least another test of these lows, if not lower lows. It remains very dangerous.